The headline numbers look strong for years. Revenue climbed, profits expanded, and the company made acquisitions across continents. Then the questions arrived. In this episode, we look at Steinhoff through a practical lens. What mechanisms can make numbers look better than they are, how those mechanisms affect real people like pensioners, staff, and suppliers, and what everyday readers can do when financial statements feel too good to be true. Our tone is neutral. We will focus on publicly discussed patterns and general accounting ideas. Where facts are disputed or still under legal consideration, we will avoid speculation. Before we touch on mechanics, it helps to define the playing field. Large retailers report performance using consolidated financial statements. When a group buys another company, the accounts of the acquired company are usually combined with the parent. Goodwill and intangible assets appear when the price paid is higher than the measurable net assets. Debt finances acquisitions, and covenants set conditions that must be met. These tools are normal. They can also create room for judgment. Judgment is where manipulation can hide if oversight fails. The first mechanism is round-tripping. Round-tripping means creating the appearance of revenue or profit by sending value out one door and bringing it back through another. It can involve related parties or structured entities that look independent but are controlled in substance. The effect is to inflate sales or profits without genuine external demand. In statements, it can show up as steady revenue growth that is not matched by cash from customers. If cash lags revenue over several periods, you should ask why. The second mechanism is the use of related parties that are not obvious. A related party is a person or entity with influence over the company. If transactions with related parties are not disclosed or are described vaguely, readers lose the ability to judge whether prices and terms are fair. In practice, this can look like profits generated through a chain of companies with similar directors, addresses, or service providers. If profits concentrate in places you cannot easily understand, pause and look for explanations in the notes to the accounts. The third mechanism is aggressive acquisition accounting. When a group buys businesses rapidly, it can assign values to acquired assets and liabilities that reduce future expenses and boost reported profits. For example, if provisions are released later, current period earnings rise. If intangible assets are recognized with long, useful lives, amortization expense is lower in the short term. None of this is inherently wrong. The issue is when valuations are optimistic and when impairments arrive only after several strong years. Large goodwill balances that remain unchanged despite operational stress are a warning sign. The fourth mechanism is supplier and inventory timing. Retailers manage rebates, promotional allowances, and inventory valuations. By moving recognition of rebates or by valuing inventory at optimistic levels, profit can be pulled forward. Again, these are areas of judgment. If gross margins expand while competition intensifies, you should read the inventory and supplier notes carefully. If cash outflow to suppliers grows faster than reported cost of sales, there may be timing differences to understand. The fifth mechanism is debt and covenant pressure. When covenants are tight, management has an incentive to present numbers that keep ratios within limits. If debt funds acquisitions that do not produce cash quickly, pressure builds. Watch for increasing leverage, complex refinancing, and short-term facilities that need constant renewal. Complexity itself can be a red flag when it obscures the underlying cash generation of the core retail operations. Now to the human impact. Pension funds that held the shares saw values fall sharply. Employees faced uncertainty as restructuring plans emerged. Suppliers had to decide whether to extend credit to stores where demand was real but corporate guarantees were in question. Landlords, logistics providers, and service companies recalibrated their exposure. When accounting confidence collapses, the numbers on a page turn into delayed payments, job risk, and reduced retirement balances. It is important to separate three timelines. The first timeline is the years of reported growth and acquisitions. The second timeline is the period when questions were raised by analysts, journalists, and auditors. The third timeline is the aftermath, which includes investigations, leadership changes, restatements, litigation, and creditor negotiations. Each timeline carries lessons. Growth and acquisition sprees deserve extra scrutiny. Early questions should be read carefully rather than dismissed as noise. In the aftermath, focus on how governance is rebuilt and how creditors and investors are treated. What can an everyday reader do when they look at a set of accounts? Start with cash. Does cash from operations grow in line with reported profit over several years? If not, what do the notes say about working capital, receivables, and payables? Next, look at related party disclosures. Are there many, and are the descriptions specific? Then look at goodwill and intangible assets. Are they large relative to equity? Have there been impairments, and were they delayed? Read the audit report. Does it include key audit matters about revenue recognition, related parties, or valuations? Finally, check debt maturity schedules and covenant descriptions. Short-term debt bunched into the next 12 months raises risk. Language can help when you talk about concerns without making accusations. Use neutral phrasing. Say, the gap between profit and cash generation is larger this year. I would like to understand whether working capital explains it. Or say, related party notes are extensive. Can management provide additional detail on pricing and control? This tone invites clarification without implying wrongdoing. If you are a trustee or a retail investor engaging a fund, ask how the fund monitors these signals and what limits are set for concentrated positions in complex groups. If you are a supplier or a landlord, your decisions are more immediate. Consider credit insurance, shorter payment terms, and visibility into store-level performance if possible. Avoid blanket exposure that assumes the group guarantee is risk-free. Watch covenant testing dates and listen for refinancings that signal stress. If you are an employee, monitor official communications and understand your rights in restructuring processes. If your retirement fund holds shares in your employer, ask your trustees how they diversify and what they learned from past events. One positive outcome after accounting failures is improved governance. Boards can be refreshed. Audit committees can strengthen independence and rotate advisors. Internal controls can be rebuilt with clearer segregation of duties and stronger reporting lines. Regulatory bodies and stock exchanges can update rules for related party transparency and for auditor reporting. Investors can insist on plain language disclosures that link profit to cash and that explain acquisitions in terms a layperson can follow. Let us convert this into a reader's checklist you can use with any large group. First, map profit to cash from operations over multiple years. Second, read related party notes for specificity. Third, examine goodwill and intangible assets and look for timely impairments when performance weakens. Fourth, review inventory, supplier rebates, and margin trends for realism. Fifth, study the audit report's key matters. Sixth, understand debt maturities and covenants. Seventh, prefer simplicity over opacity. If you cannot explain the core cash engine in a few sentences, you are relying on trust rather than evidence. We will close with a calm summary. Accounting is a language of estimates and judgment. Most of the time, that language serves honest reporting. Sometimes incentives and pressure bend the language. Your task as a reader is not to assume the worst, but to ask for clarity where the numbers are ambitious and the cash is thin. When many good-looking results depend on complex structures and related parties, caution is rational. When confidence is rebuilt through clear disclosures and consistent cash generation, confidence can return. In our next episode, we switch from corporate accounts to the theater of social engineering. We look at the story of Anna Sorokin, also known as Anna Delvey, and we focus on how social proof and invoices were used as tools. The aim is to provide practical red flags for hospitality and finance staff, not to dramatize the past. Narration generated with AI, facts verified from public sources. No legal advice is given in this episode. The purpose is education and public safety. If you have a case tip or a documented pattern to share, use a safe channel and remove personal information that could identify non-public individuals.